Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is the first day of December. It's also my lovely wife's birthday today, so happy birthday, honey. She is 39 again for the 12th time, something like that. I can't do the math. Anyway, but doing great. Happy birthday. A couple of things to get into today. Of course, today is the first day of December. We just got through the holiday trading week, and that was a very, very good week. We had a very strong rally, 5 days of advance in a row. And again, something we talked about previously coming into Thanksgiving. You know, we had that correction going on in the markets. Kind of a couple of weeks before Thanksgiving, the first 2 weeks of November, markets were down. The AI trade is over. It's all dead, and all these type of conversations. And we kind of warned you. We said, hey, this is typically a setup as we get into the last half of November, which tends to be better trading, particularly during the holiday shortened trading week. And last week was a very good week. Markets rallied fairly strongly. We got above the 50 and the 20-day moving averages. So again, got to be careful with a lot of these narratives. Again, as we talked about before, narratives are fine. There's nothing wrong with narratives, but a lot of times they just don't work out the way that people think they do. So again, just manage portfolios for the way for what the markets are doing, rather than worrying about what all the narratives are. Because generally, most of the narratives, particularly the bearish narratives, turn out to be incorrect in the short term. Maybe in the long term they work out fine, but in the short term, more bearish narratives really tend to cost you money than anything else. So outside of that, though, we're going to be starting to get more economic data now that the government's reopened, and so we'll get a lot of economic data. We've got the Fed meeting coming up here soon, so market's really looking forward to that. Polymarket has the next Fed meeting a rate cut there at about an 80% chance. So again, the betting markets are certainly strongly betting on a rate cut at the next Fed meeting. That's feeding into risk assets as well, and that was a big reason for that turn that we saw in the markets, was increased odds of this rate cut coming up in December. Now, having said that, also don't forget that the first 2 weeks of December tend to be fairly weak, fairly choppy, because we now have mutual funds making their annual distributions for the year. So again, first 2 weeks of December, expect some sloppiness. The average rate of return has been about 0.3% for the first 2 weeks of December historically. The latter half of December tends to be much stronger, and that's where your Santa Claus rally comes in. So you get this kind of mutual fund distribution going the first 2 weeks, markets under pressure. Then you get portfolio dressing, window dressing going to year end. This is where all the portfolio managers want to have all the right positions on their portfolios, so you get a lot of buying in the last 2 weeks of December, first 2 days of January, as they're getting positioned for the new year. So again, just that seasonality doesn't mean it always works out that way. Things can happen, but just something to pay attention to. Okay, we're going to get into a few things this morning, talk about why bear markets are a good thing. But before we get there, I got an email yesterday. And this email said, I'm putting a lot of my money into safe assets right now. What's your outlook for the next 3 to 6 months? Great question. So the question, though, was, I'm looking for a 5% pullback to put my money to work. That's a dangerous statement. So here's what you need to know before the bell this morning. Should I wait for 5% corrections to put money to work? Probably not. 5% corrections occur once or twice every single year. 5% corrections are normal. They happen every single year. 10% corrections happen at least once a year also. We just say, just this year, we had a near 20% correction back in April. We just had a 5% correction in the first 2 weeks of November. So if I'm always waiting for a 5% correction to put money to work, that becomes a problematic issue. Again, your window is too short for that type of investment strategy. 5% corrections occur all the time. Let me show you some examples of what I mean. Let's just look at a chart of the markets. And let's just pick a point here real quick. Let's just say that we just, randomly bought right here at this peak of the market. And again, this is completely fine, right? We buy here and we put some money to work. And yeah, the markets have a correction following that. Okay, so I'm down a little bit right now. But now let's start moving forward, right? Markets start to rise, rally, and then we say, okay, I'm going to wait for the next 5% correction to put money to work. Well, the problem is that 5% corrections, yes, they happen, but by the time they happen again, this was a 5% correction right here, you've given up potentially all of these gains just to get this correction of action. And again, so if we keep moving forward, let's just keep waiting. We say, okay, well, we're going to wait for the next 5% correction to put money to work. And again, we're eventually going to get there. But the problem is that when we eventually get there, again, we've given up a lot of gains to get to this 5% correction. This is the problem with waiting for very small minor corrections in the markets. You're going to wind up giving up a lot more of your gains. You're better off just investing in the markets and then saving some cash. Every month when you get paid, put some money into a bank savings account, whatever it is, put it to a money market account. And then when you get these 5% corrections, have some cash available to add to them. But but putting your portfolio into an all defensive position, waiting for a 5% correction, you're going to wind up giving up a lot more gains over time. Markets rise over time. And this is really kind of a key critical point, is that markets continue to rise over time because of inflation, because of economic growth, because of all these things. Yes, you're going to have corrections. As I said earlier, absolutely. We had a 5% correction just a couple of weeks ago right here, and now we're starting this recovery process. And so you're saying, okay, I'm going to wait now until I get the next 5% correction. These corrections happen consistently over time. And so again, we want to maintain some type of exposure to markets to capture the growth of the markets over time. That's going to happen. But trying to defensively, position your portfolio and time market entries is you're going to give up a lot of your returns over time, give up a lot of your gains, and really impair your portfolio returns over time. This is just one of those things. But this is, again, 5% corrections, absolutely normal. That's normal volatility. You should expect that in your portfolio whenever you invest. That's just a function of being in the markets. What we want to try to avoid is the 30, 40, 50% declines, and there's no evidence of that occurring in the markets anytime soon. Right now, we don't have the makeups, we don't have the credit events, we don't have any other type of issues right now, at least showing up in the markets. Again, this is why we watch credit spreads, this is why we watch a lot of other indicators that would pre-warn of a much larger drawdown in the markets. Those don't exist right now. Volatility is low. Lots of exuberance over the markets. Again, markets are going to trend higher here, at least for the time being. But again, worrying about a 5% correction, you're going to give up a lot more than you're going to protect on downside. As Peter Lynch once said, he says, more money has been lost predicting bear markets than the actual bear markets themselves. So again, just kind of keep that in mind. That's what you need to know before the bell this morning. All right, we'll come back. We're going to talk about bear markets, why they're a good thing, and some other stuff. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. By the way, that upcoming conference in January, tickets are selling pretty quickly right now. A little bit more quickly than I thought they would this early, because the conference is on January 17th. And seating is very, very limited. Again, we're going to have a lot of people there to talk about AI, crypto, a whole variety of other things, financial planning. We've got Ed Slott coming in, who's one of he's America's retirement planner. So to talk about retirement planning, Daniel Kang talking about crypto strategy, and particularly stable coins. And then, of course, Brian Dunlap from BlackRock to talk about artificial intelligence and kind of the future of where that's headed. So, again, it's going to be a very, very good conference, but tickets are very limited. So if you haven't bought your ticket yet, you may want to get a move on that, A, before the price goes up, but B, because before they sell out. So, again, all right. So a couple of things that we've got to kind of get into today. This weekend in the newsletter, if you haven't read the newsletter yet, again, if you haven't subscribed to the newsletter, you're certainly missing out on probably some of our most important work every week. But we talked specifically about the year-end rally, and something that we had talked about kind of on previous occasions, that the market's kind of getting set up. That correction in the first couple of weeks of November was a good setup for a year-end rally. Again, what you need for the markets to rally is you need breathers to occur. And so when the market takes a breather, that allows things to reset temporarily, and you get a little bit better entry points to add to equity exposure and things like that. And this has been very common. The market's playing out very close to seasonal expectations. Generally, in the first 2 weeks of November, you typically get some weakness. You get a rally in the end of November, a couple of weeks of weakness in December, and then a rally into year end. So far right now, we're playing very, very close to kind of seasonal tendencies for the markets. And again, something to at least kind of pay attention to. But, as we were going through in this weekend's newsletter, again, the average S&P 500 returns since 1950 have been, the strongest in November and December. On average, you're pushing out, about 1.5% in the month of December, 1.8% in the month of November. November was a little bit weaker this year because you had that 5% correction-ish in the first part of November. So we did eke out a gain in November. But that kind of sets up December to be a little bit stronger month. And again, that's just kind of seasonal tendencies going back, to 1950. But, one of the things that is also important to pay attention to is that we've now had 6 straight months in a row of gains. That's also a very, very long stretch of gains back to back to back to back. So that is kind of a negative, kind of factoring in, could December be weaker than expected? Sure, absolutely, right? And this is the thing about seasonal tendencies, statistics, those type of things. I was watching a good example of this as I was watching the A&M Longhorn game with my son this weekend, and A&M went into the game this weekend undefeated, 11-0. Now, statistically, that's a very long win streak for any football team, right? To win 11 games, be undefeated, that's a fairly long streak. And you're just increasing the probability that eventually you're going to lose a game, right? No team is going to be undefeated forever. They're eventually going to lose a game. So the odds increase. The more games you win in a row, the higher your odds become that you're eventually going to lose the game. Right? It's just a function of factors, right? But it's just statistics, averages, those type of things. That's all we're talking about with the markets, is that statistically, what markets have done this time of the year have been positive. Does that mean it happens every year? No, it doesn't. And we've had, again, six months in a row of advances, right? It's been a good streak. Eventually, that streak will end. Rarely do you see 7, 8, 9, 10 months in a row of advances. Do they happen? Absolutely. They happen very rarely, but they do happen. So again, we're kind of getting into that length of advance that we're going to have maybe a weaker January or a weaker February than expected. We're going to have a corrective month sooner than later because we're just getting statistically very long in the tooth. But again, this is part of managing money, part of understanding these things, is that risk and volatility are part of the game of investing in the markets. And so again, going back to the conversation earlier about the email I got, it's like, I'm buying a lot of defensive assets, and when do you think there'll be another 5% correction? Could be in January, right? Could be 6 months from now. But that's just part of the game. We just have to understand that. This is why it's important to kind of navigate markets and pay attention to what's happening with the markets, but also pay attention to the risk you're taking in your portfolio. A lot of people get themselves in trouble by taking on way too much risk. I just posted a chart on Twitter this morning. We have a record amount of dollars being invested in double leveraged, triple leveraged ETFs. It just hit a record last month. So investors are taking on a tremendous amount of leverage through ETFs. Now, this isn't margin, right? Margin loans are a different thing. Those margin loans also, by the way, at a record, almost 1.2 trillion. So investors are willing to borrow money to invest in the markets. But even if they're not borrowing money and we have that recorded leverage, they're also buying leveraged assets. So they're leveraging in multiple different manners to get more exposure to the markets, increase greater returns. That's fine until it's not. Because we've talked about before, the problem with leverage, it's a double-edged knife, and the edge that cuts you the deepest. So again, just remembering kind of how markets work over time. But there are some concerns that we need to pay attention to. And I'm not dismissing those just because I'm suggesting that markets are probably going to rally into year end, which statistically speaking they should, doesn't mean they won't. Again, we just talked about a few minutes ago about first 2 weeks of December. That's when everybody distributes gains. Market's going to be a little bit weaker this morning. Dow's down about 200 points right now. It's the beginning of the month, coming off a great week. So a little bit of a pullback here is not surprising. But that's just part of volatility. Now, volatility is a very different thing than a bear market. Those are two different things. And we have to separate those two things. And this is where investors tend to get themselves in more trouble than not, which is they read a lot of bearish headlines. They watch bearish videos, et cetera. It's like, oh, the markets are going to crash 50%, whatever. Okay, probably will. At some point, we're going to have a 50% correction in the markets at some point, but it's not going to happen overnight. There's going to be signs. There's going to be things you're going to notice that are going on in the markets that will tell you that a larger correction process is underway. But outside of that, you're going to have corrections. 5, 10, 15, even 20% corrections like we had back. Again, we just had a 20% correction back in March and April. Everybody's kind of forgotten about that because we immediately ripped off to new highs, but you went through a 20% correction. That reset a lot of the table at that point. We corrected a lot of kind of grossly overbought conditions. Now we're getting back to these more overbought conditions, but when you're looking at weekly and monthly trends, we corrected a good bit of action during that 20% correction. So that gave the markets room to rally. Again, that was a good opportunity to put capital to work, which is what we were talking about back in April. We were buying NVIDIA and some other stuff back in April because that correction gave you a good opportunity. Just like we added to our portfolios early, on Monday last week, same reason is that correction gave us an opportunity to add money to portfolios. Corrections are a good thing. Bear markets are also a good thing. But you have to be able to navigate those issues when they occur. Spencer Jacob, one of my favorite writers for the Wall Street Journal, wrote this article talking about, we need a good bear market. And he's right. We do need a good bear market. Bear markets do a lot of good in terms of resetting markets. One of the interesting kind of phenomenons is California. And California for years has had trouble with managing their forest. And they've made decisions in the past not to deforest. Right. And so when you make decisions to not maintain the forest, you potentially create the issue of negative outcomes. And this has been a problem they've gone through. And this was a study by MIT, by the way. MIT published a study, said decades of rushing to stamp out flames that naturally clear out small trees and undergrowth has had disastrous unintended consequences. This approach means that when fires do occur, there's often far more fuel to burn, and it acts like a ladder, allowing the flames to climb into the crowns and take down otherwise resistant mature trees. This is the same thing as a bear market, and this is one of the problems that's been created by the Federal Reserve in really since the turn of the century, more than anything else. A bear market's not a bad thing, but since the turn of the century, the Federal Reserve has taken on this idea and this mantle that recessions are a bad thing. We need to avoid recessions. Recessions and bear markets are not bad things. They reset the economy. They clear out excesses in the economy. And they clear out malinvestment. They clear out, the all the stuff, the complacency, the excess exuberance, all those type of things that get built up during a bull market. A bear market resets the table and allows for opportunity. It resets valuations. It resets credit. It resets a lot of things. And yes, they're painful. But that's, again, it's part of the process. It's clearing out this underbrush. And look, forest fires are a good thing. They, even after the forest fire, yes, it creates a lot of devastation, but it provides nutrients to the ground. It allows for new growth. It cleans out a lot of the stuff that's built up over time and allows for a healthier forest to grow over time. And again, but when you try to consistently prevent things, then you get a buildup of the negative outcome. And this is the same thing with the Federal Reserve. They continue to try, through manipulation, through low interest rates, or through quantitative easing, whatever it is. Even the government itself has been doing everything they can to try to prevent recessionary outcomes and bear markets. Because it's not good. If you're an elected official, a bear market is almost a surefire way not to get reelected, right? If you have a recession on your watch, you're not getting reelected most likely, unless it happens early in your watch, because people vote with their pocketbook. But this is where the Fed has been doing this, and since 2010, this really became a third mandate for the Federal Reserve. Ben Bernanke back in 2010, I've stated this before on the show, said that the reason they were doing the second round of quantitative easing, so they did quantitative easing round one in 2008, and that ran through June of 2009. That ended and the market corrected. Markets were down almost 20%. And in September of 2009, the Fed stepped in, Ben Bernanke stepped in and says, we're going to restart quantitative easing. We're going to do another $1 trillion worth of quantitative easing. And when he was asked why, he said, well, the reason we're doing this is that quantitative easing lifts asset prices. And if I lift asset prices, that creates a wealth effect, which then spurs consumer confidence, which then leads to economic growth. Completely logical. And that's what they did. And so every downturn, we've immediately stepped in with some type of crisis bailout, whatever it is, right? Silicon Valley Bank, whatever it is, we step in, we start flooding the system. 2020, we have the pandemic, shut down the economy. We have a bear market, market's down 35%, immediately step in. We're bailing out high yield bond ETFs. We're bailing out banks. We're bailing out everybody. The problem is by doing that, you're stopping that cleansing process from happening. You're stopping the natural cycle of the markets. You're stopping that reset of valuations. You're removing the ability for the downturn to clear out malinvestment, to get rid of companies. And again, we've talked about the zombie companies in the Russell 2000. By stopping these downturns, we continue to allow for companies that really shouldn't be in business to remain in business. But see, a downturn would clear that out. It would make the markets healthier. But again, we don't want the pain, right? We don't want to go through that pain of that downturn because, again, it's, people lose jobs. Politicians lose elections. And we don't want that. We would rather have this bliss, right, of having things kind of get bailed out. But again, even though we're bailing these things out, you're not going to stop the natural evolution of bear markets. And when I'm talking about bear markets, I'm talking about full market cycles. Just recently wrote the article, Full Market Cycles. It's on the website. If you go to realinvestmentadvice.com, it's about week before last, I think, was the article on full market cycles. Understanding full market cycles is very important. Because for every secular bull market, you've got to have an eventual downturn. And when those resets occur, they tend to be painful and they tend to wipe out a big chunk of the gains from the previous bull market. And the longer that you extend these markets by monetary and fiscal interventions, the bigger that downturn is going to be. And that's just part of that natural process in the markets. The markets will eventually, regardless of interventions, regardless of anything else, they will eventually revert to their mean. Mean reversions are not something that we can eventually stop or effectively stop forever. We can certainly extend the cycle, but we can't stop these. And again, we can take a look at valuations. We talk about the importance of valuations. Valuations, a terrible short-term indicator. Valuations are nothing but sentiment in the near term. So they tell you, valuations tell you nothing about the markets over the next year or two, other than right now with valuations elevated, valuations are very bullish. That means markets are likely going to be higher. But what valuations do tell us is that long-term valuations are going to lead to lower returns. And that's because eventually valuations have to revert to their mean. And so the green shaded area in this particular, if you're driving, don't try to look at your phone. But when you get home, pull up the video, the charts here. But it's also in the article on the website, realinvestmentadvice.com is today's article. But the deviation of the market currently from its long-term exponential growth trend going back to 1900 is the highest level on record. We're currently running about 167%. In 1929, we were around 110%, and we were at 151% back right at the turn of the century. So we're more elevated than any other kind of bull market in history, and that's because we've continued to support and push markets higher by intervening, right, and stopping downturns from happening. Again, the correction in 2020, when we had the pandemic, when you shut down the economy, we should have had a 50 to 60% correction in the markets, and that would have been a great thing, right? It would have provided investors a huge amount of opportunities, but we cut it short by the Federal Reserve stepping in, bailing out markets, et cetera. And so we began to immediately reverse that mean reverting process. We never completed that mean reversion process to get valuations back to where levels were opportunistic for investors to make real long-term investments. But again, that's just, I'm not saying this is going to happen. I'm just saying this is what has happened and things that we kind of need to know about. And again, I was talking about margin debt earlier. This is margin debt and the market. So free cash balances are, inverted. That is, free cash balances are what's left over in terms of your cash after you go into margin. And so that's an inverted scale. And again, when free cash balances are declining, markets are rising because margin debt's rising. And we're currently running a peak in margin debt that we've never seen before. Right? It's an all-time record on margin debt. So again, just, this idea that we're just taking on a lot of leverage because there's no risk in the markets, that's because we're not allowing bear markets to occur. We're stopping bear markets from forming because we don't want the consequences. We don't want that negative push. But again, this is that's what's healthy, though. And again, nobody wants to hear this, right? But a bear market's a healthy thing. It's a good thing. We should be wanting a bear market. And we should be okay with them occurring. A recession, and again, when I talk about a bear market, I'm also talking about a recession. Recessions are good too, because they allow the economy to reset, allow productivity to increase, all those type of things. But by stopping them, we create more problems long term. We create wealth disparity. We create wealth gaps. We create all these things because we're stopping the process from occurring. When you start doing things that shift economic wealth from the middle class to the upper class, in which QE was a huge wealth transfer mechanism to transfer wealth from the middle class to the upper class. But also things like ESG and all these other endeavors that we've done over the last 10 years, those have been great wealth transfer mechanisms. So we've created this transfer system in the economy from the middle class to the wealthy. And so now we have this huge wealth gap. But allowing a bear market to occur would have eliminated a lot of that. It would have gotten rid of the malfeasance. It got rid of the malinvestments, would have realigned home prices. It would have done a lot of good things for the economy to keep that wealth gap from becoming so broad. But now we're amplifying that wealth gap through these processes, through these choices that we're making to avoid the recessionary reset. And the problem with that, of course, is that when the recessionary reset eventually occurs, and it will, don't know when, could be 5 years from now, could be 10 years from now, but eventually when that recessionary reset occurs, it's going to be much more painful than it would have been otherwise if we would have allowed some recessions to kind of occur along the way. If we would have allowed 2020 to play out, if we would have allowed 2015 when we were having 2012 when we kind of had a manufacturing recession, allowed that to play out. Those would have been a little bit deeper corrections. It would have resolved some of these issues. But instead of allowing this to occur, we stepped in with QE, some form of bailout, cut interest rates, whatever it was, and kept the party going. And so the party's been great, right? Over the last 15 years, you've been able to make a lot of money, no doubt. As long as you've been participating in the market, it's been fantastic. But the consequence will ultimately be a much larger correction over time. And again, this is why really since the turn of the century, when we're getting these crises occur, they're much bigger than they would be otherwise. Again, a downturn in the market should not lead to a banking crisis, right? A downturn in the market should not lead to a crisis in real estate. But that's that malinvestment that got built up. And so when you get that eventual trigger, it's a lot bigger than it should be. So anyway, just something to consider. And so I wrote that article. It's on the website today. And again, it's just kind of a really kind of good idea to think about, because eventually these things are going to occur. And this is why when you're looking at your portfolio, you have to kind of start thinking about future outcomes. And again, I was talking earlier in the show about worrying about a 5% downturn. 5% downturns are the price of admission for playing the market. You're going to get corrections. Bigger corrections are going to occur, and this is where this is why you should look at your portfolio, review your portfolio, make sure your companies have good fundamental positions. And again, start this process by getting rid of all the narratives, right? And again, there's tons of them out there right now. There are tons of people that are, we're about to have a major housing crisis. They've been saying that for 3 years, and it's someday, yeah, we'll have a housing crisis, but it's not today. It's not next week. It's not next month. Yes, the markets are going to have a 50% downturn, but it's not going to happen next week, next month, not even next year. It is eventually going to happen, sure. But again, as investors, what our job is to participate with the markets that we have today and be aware that these risks are out there and that eventually we're going to have that forest fire that does a lot more damage than it would have been otherwise if we had done some regular maintenance, right? So the way we can avoid, so we need to be able to participate but avoid that forest fire when it eventually occurs. And you do that by making sure that you've got a good portfolio review process in place, that you're reviewing your portfolio for fundamentals. Because at the end of the day, what's going to protect you against downturns is going to be fundamental quality. And again, when you take a look at the Russell 2000, you've got 40% of the companies in the Russell 2000 that have what we call zombie companies. They're having to issue debt to stay alive. That's not the kind of company you want to own in your portfolio. Because when you get a downturn, those are the companies that are going to get hit the hardest. So you need to make sure, do they have revenue growth? Do they have free cash flow? Do they have those type of things? Because that's what's going to protect you. Does that mean your stock won't go down during a decline? Absolutely not. But the difference is that I can suffer a downturn and be okay. I have to survive the downturn. That's the question. There's a difference between suffering and surviving. And for a lot of investors, they won't survive the downturn because of leverage, excess risk, poor fundamental quality, those type of things. Always maintain a liquidity buffer as well in the portfolio. We're talking about 5% downturns. Markets are. I can invest today in the markets, and yes, I'm going to have a 5% downturn at some point within the next 6 months to a year. It's going to happen. Happens every year, a couple of times a year. I want to maintain some liquidity so I can use those downturns to my advantage. Liquidity provides you opportunity. It also provides you a hedge against volatility. So if I have a liquidity buffer in my portfolio and the markets take a downturn, I don't decline as much as the market because of liquidity. And now I can use that liquidity for opportunity. This is why you got to be careful with private investments that have no liquidity. So if you've got a bunch of your investment capital in illiquid assets, real estate, private equity, private credit, you're going to be in a very problematic situation when the eventual forest fire occurs, because you have no liquidity, you have no exit. So, resist. It's important to resist chasing the markets. Participate with the markets, understand what the markets are doing. This is when we spend a lot of time talking about market trends and technical analysis and all these type of things, because that trend will allow you to participate, be aware of that trend. Is it positive or is it negative? And whether or not we're breaking those trends. When you begin to break trends, that's when things become a lot more critical. That's where the liquidity buffer steps in. This is where fundamentals really start to matter. And this is also where you need to take some action. As long as the fundamental trend remains in place, you're okay. And remember, the one thing about bull markets is that they make us think we're a lot smarter than we actually are. I can buy assets that are going up in price, and I can come up with all the narratives why. At the end of the day, it's an asset. It's going up in price, not because of a narrative, only because there are more buyers than sellers. That's the only reason it goes up in price. Eventually, that reverses. Eventually, you will have more sellers than buyers, and the price will go down. And it doesn't matter what asset class it is, Bitcoin, gold, stocks, bonds, whatever it is. You're eventually going to get a reversal of that buy-sell imbalance. And that's what drives prices. Now, the narratives are fine, right? They make for entertainment. They make for great clicks and views. Narratives are fine. But at the end of the day, it's the buy and sell demand that matters. That's what moves the price. If everybody was just buying and selling and you had a perfect balance all the time, for every buyer there's a seller, which is true. It always is. Got to have both. Prices would never move. You need an imbalance of buyers and sellers. You need more people demanding and willing to pay a higher price to make prices move higher. And you got to have an imbalance of sellers to buyers when prices are falling. That's just the way markets work. So set all the narratives aside and just focus on the price action, because that will keep you out of trouble. And more importantly, we kind of remain emotionally balanced. Again, one of the problems with narratives and YouTube titles and all this type of stuff. And again, today's headline for this YouTube is bear markets are a good thing, right? So as soon as you put bear markets on a YouTube, people are going to watch it, right? Because, it's like the news. If it bleeds, it leads. So if it's a negative headline, it's going to get views. And that's okay. Just don't allow your emotional side to overtake your logical side. Because that's easy. We know one of the things that we do during declines is that we get emotionally driven by the correction. It's like, oh my gosh, markets are going down. I have to do something. Sometimes doing something is the worst action to take, depending on what it is. And again, sometimes you need to take action, but you have to separate out logical action from emotional need. And that's hard to segregate at times. Markets are going down. Oh my gosh, I'm losing money. Losing money is part of the price of admission. Is this a bigger correction? Is it breaking trends? Is this an opportunity to put capital to work? Or is this an environment where I need to be cutting risk? That's the hard part about investing is separate. When markets are going up, that's easy, right? Just put money in, market goes up, everybody's happy. It's during those declines that we make the mistakes. During that correction in the first 2 weeks of November, AI's dead. Don't want to be in the AI trade. AI's over. It's all done and over with. Whatever the headline was. But was that the end of a trend, or was that a correction in the trend? See, we have to step back and logically look at these things and make decisions relative to our portfolio. And this is why it's just important, to monitor these kind of macro and technical signals in your portfolio. And just saying, look, here's my portfolio. Here's the macro signals that are going to drive my allocation. Here's the technical signals that are going to drive my buy-sell decisions. And allow those processes to work. This is why we've talked about previously is about having an investment policy statement, and that if you don't have an investment policy statement, you're already kind of managing your portfolio with one arm tied behind your back, because you're just buying and you're just buying stuff. You really don't know why you're buying it because you don't have a policy. You're buying it because it was recommended on television or some friend told you about it. So I'm going to buy some of this, or I heard, some headline about this, but you don't have any structure to why you're buying it, how you're buying it, when you're buying it. So the first good step into managing your own portfolio, which is, being a do-it-yourself investor is great, but at least have a process. And that's what an investment policy statement will tell you. If you can't write it down and say, this is why I buy stocks, this is when I sell stocks, this is how I allocate my portfolio, you need to step back and start that process, because that will help you define ultimately what your process is so that you have something to follow. Otherwise, you're just kind of doing things that are all emotionally driven, which never works out. Again, works out fine as long as markets are going up. Really hurts you when markets go down. So anyway, there's a whole checklist of items in today's article on navigating bear markets. So again, if you want to go kind of get all those kind of rules just to add your portfolio of ideas, that's on the website. I post these kind of tips and tactics every week on our blog. So when I write blogs or even write the newsletter, I always add a few tips in there about how to manage your portfolio. And, so again, those are just kind of good little snippets to snip out, throw in a book somewhere, and just kind of give you a reference point back at some point to look at and say, okay, what am I doing with my portfolio? How am I managing it? Because, these little ideas, they can help you focus a little bit better about the things you need to consider within your overall portfolio structure. So, all right. Having said all that, a couple of things going on this week. We do have a good bit of economic data coming out this week. So again, that'll be moving markets. We're getting set up for the Fed meeting. That'll be moving markets. Again, don't be surprised if we get a little bit of weakness in the markets here over the next few days. And particularly with Bitcoin under a lot of pressure, that's also going to weigh on kind of risk asset taking. So again, a few days of sloppy trading here will not be surprising at all. But again, we need to keep, we'll keep watching on, kind of the moving averages. We'll watch the trends, those type of things. Again, there is a little bit of elevated risk right now, so be a little bit cautious with how you're allocating your portfolio. But again, kind of the dynamics for an end of the year rally are still certainly in play, at least at this point. Can that change? Absolutely. And we'll certainly, let you know if those dynamics are shifting in the wrong direction. But right now, this is all, kind of playing out to statistical norms. So again, all right, make sure you get signed up, get your tickets. Go to the website, realinvestmentadvice.com, sign up for the newsletter. Very important read every week that has a lot of our technical data in it about what markets are doing, where they're headed. Over the last 3-4 weeks, we were talking about the correction in the markets. Last week, we're talking about, hey, this is a good time to start buying into the market, and we had the rally last week. So again, that's covered every week, and we go through technical support and resistance levels. That's all in the newsletter. Just subscribe online, realinvestmentadvice.com. While you're there, be sure and click the link to get your tickets for the upcoming Economic Summit, January 17th. Those tickets are selling very quickly. We'd certainly love to see you there. We're actually going to have a mixer the night before as well, so if you want to come attend that also and visit with all the speakers, we have limited seating for that also. Very small group, kind of an intimate setting to visit with all the speakers, but that ticket is available for you also. It's all there at the website. Just click the link at the top of the page, and it'll take you to Eventbrite, and you get buy your tickets and get all set up. All right, have a great day. We'll see you back here tomorrow for our interview with Brent Johnson and talking about the dollar. All tomorrow coming up on the Real Investment Show. See you then.